All right, so in this lecture, we are going to do IAS 20. Again, another important standard when it comes to exam. The number of the standard is IAS 20 and the name is Accounting for Government Grants and Disclosure of the Government Assistance. Now, the first thing you need to understand is why the government will be giving the grant to the company. This is the first question that needs to be answered. Why the government will be giving the grant to the company? When the government is giving grant to the company, obviously there will be some objectives behind that. There will be a reason behind that. There will be an objective behind it. For example, the company is currently using the conventional assets and the government wants the company to buy, for example, the eco-friendly assets. Now the government says to them that if you buy the eco-friendly asset, we will be paying you 20% of the cost in terms of the grant. Okay, fine. Another example may be, for example, the government wants to create employment in any area. Let's assume a deprived area, a backward area. The government wants to create employment over there. And the government says to the company, if you hire the people from that area, if you employ the people from that area, we will be, let's assume, paying you 50% of the payroll cost, payroll expenses, 50% out of it. Now, there can be many examples. So when the government is giving a grant to the company, and when we say the grant, it is going to be a monetary amount, dollars, monetary amount. The grant, dollars, monetary amounts. So whenever the government is giving the grant to the company, the government will be having an objective behind that. It can be anything. It can be either related to the acquisition of asset. It can be either related to the creation of employment. It can be either related to training, to train the people over there. It can be related to switch the operations in any area where the government wants to make a development. So it can be anything, etc., etc. Now, how to account for this grant? The main question why we are studying this standard is how to account for that grant which is being given by the government to the company, how to record that grant in the books. Now, when you say a grant, this is generally an income for the company. When you say grant, this is generally an income for the company. Let's say the government said the company to buy the eco-friendly asset. If you buy the eco-friendly asset, we will be giving you 20% of its cost. The government is always in an authoritative position. They can even tell the company that buy an eco-friendly asset within a year, otherwise we won't allow you to continue the operation. In that case, the company needs to buy the complete asset themselves. The government will not be paying anything to them. The government is in a position to say that. They can. But the government is friendly towards the company because the company is doing something better for the economy, creating employment, paying taxes, and many things like that. The government can tell the company to hire the people from there. They can impose such a regulation on that company, and the company will not have any choice other than that. But the government is not going to have that dictatorship approach. They are saying if you hire the people from there, we will be giving you 50% of the payroll cost. Now, the company is saving the 20% in terms of the eco-friendly asset. The company is saving 50% in terms of the payroll cost. They would have spent this thing themselves, the government says so, but they are saving that amount. So the amount that is being saved by the company is generally recorded as an income. So the grant is generally an income for the company. Now, let me take you to the F3 paper or FFA paper, which was your earlier accounting paper in the ACCA. There was a chapter over there named accruals and prepayments. Hopefully you remember that, accruals and prepayments. There were many things in it. There was accrued expense, accrued income, prepaid expense, prepaid income. So we'll be talking about the prepaid income, prepaid income. The other name was income received in advance, income received in advance. Another name was Unearned income, unearned income which has been received, but you have not earned it. You have not provided the services related to that. And similarly, the last name was the deferred income. All of these things are the same: prepaid income, unearned income, income received in advance, deferred income. And do you remember what we used to record this unearned income? The double entry used to be debit cash and credit liability. Why you are debiting the cash? Because we have received the amount in advance. And why you are crediting the liability? Because you have not provided the services yet. Let's assume I work for a university and I teach over there. They are giving me the salary in advance. The moment I get the salary, I debit the cash and credit the liability. Why the liability? Because I am yet to provide the services against that. So it's initially the liability which has to be recorded. And once I'm done with providing the services, what I'll be doing, I will be de-recognizing the liability by debiting it, and credit goes to the profit or loss. Now I will be able to record the income. So this used to be the process, if you remember, in accruals and prepayments. The same concept will apply over here. And if you remember this concept, you are done with IAS 20. The IAS 20 majorly belongs to this double entry, that the grant the company is receiving is an income, but this income should be recorded initially as the deferred income, income received in advance. Why is that? Because the government is giving you the grant and there are conditions attached to it. Let's assume they are saying you to buy an asset and you have to keep it, let's assume for a certain number of years, let's assume 3 years or 4 years or 5 years. Now, you have to comply with those conditions over multiple years. That is why I cannot record the grant immediately as an income in my financial statements. The government says you have to hire the people from there for the next 5 years, and we will be giving you the wages and salaries in relation to that. Now, see, we are getting the amount in advance, but we have to comply with the condition over the years. So what we will be doing, we will be debiting the cash and we will be crediting the deferred income. This is the treatment of the income received in advance, and exactly the same will apply to the grant. So remember the idea that IAS 20 is the grant, and this is the monetary amount which is being given from the government to the company. And there are always going to be conditions attached to it. That is why we won't be able to record the grant immediately as an income. Instead, we will be recording the income as deferred income, which means the liability. And when systematically the conditions will be complied, the entity will be de-recognizing the deferred income and they will be crediting the profit or loss. That means recording the grant as an income. This is the general treatment. And obviously, we have the separate treatments for multiple types of grant, which we'll be studying in a while. So this is all about the idea of the IAS 20.